Hey guys, Eric here, Mr. Fired Up Wealth, and I hope you're doing great. I'm doing excellent, and I'm really excited to announce a new video series that I'm working on. So before we forget, let's go ahead and subscribe, please, to the channel if you haven't already. Click the little red button on the bottom right-hand corner of your screen that says subscribe, and then there's a little bell that you need to click, and that bell will give you notifications whenever the channel releases something new. And trust me, you're gonna wanna see this video series, so please subscribe and get notifications. Now, there's gonna be 6 videos over 6 weeks. There's gonna be 10 stock picks per video. So of course, that's a total of 60 stock picks that you can buy and hold over the next decade. Now, these are gonna be focused on different industry sectors because at the end of the day, you need to make sure you're diversified within your portfolio. Now, ultimately, everybody's gonna be a little different on how they manage that portfolio, and you might be a little heavier on tech or finance or whatever it is that you like or that you know. For me, I'm a little heavier on tech because that's my background. I know that industry well, and I invest in what I know. But with that said, it's important to make sure you're still diversified and that you have a little bit of every little sector there is. There's 11 total sectors, and it's important to understand at least the benchmark that the industry goes by so that you don't have, just all tech or all finance or all healthcare or just those 3. You want to make sure you cover all 11 sectors. So do you understand what the 11 sectors are? Are you diversified? Please stay tuned and find out. Okay, guys, so jumping right into it, let's talk about the Global Industry Classification Standard, also known as the GICS. This is from Fidelity's website. I'm just going to spend a minute on this and then kind of move on. This is important to understand what this is, and I'm going to break these down in detail. It's pretty cool, so stay tuned. So it says, just as chemists need universal and stable units of measure to create precise formulations, investors need objectively defined investment categories to design and carry out efficient portfolio strategies. While each company may be unique, many businesses and economic factors could impact similar companies in the same way. As a result, analysts rely on consistent and unbiased classifications to compare companies, evaluate industries, and isolate regional from global trends. So before the GICS, in 1999, there was a Standard & Poor, which you've probably heard of before. I won't go too much into that, but why is it good? The GICS is now an accepted framework for investments because, number 1, it's universal. Number 2, it's accurate. Number 3, it's flexible. Number 4, it can change. So those are kind of the 4 reasons why this is generally accepted. When you go into your Fidelity account and maybe your brokerage, you'll actually see the GICS framework, and it breaks down. Here's the 11 sectors. So the GICS comprises of 11 different sectors, 24 industry groups, 68 industries, and 157 sub-industries. So it's very granular. This is far more granular than the 2-level hierarchy that they used previously, and the methodology is still very much based on industries, but the sectors now reflect our current economy. So communication services, it used to be telco, but now you'll see cell phone in here, as well as Twitter and Snapchat and Facebook in there. So social media is part of communication services. Consumer discretionary, retail, things like that, consumer staples. You've got your Procter & Gamble's, your energy, financials, healthcare, industrials, information technology, materials, real estate, and utilities. And so just going to the last part here. So GICS and portfolio management, obviously the reason we're talking about this is because we want to make sure that we're diversified in our portfolio. So the methodology provides transparency and accuracy. The 4 classification levels allow basically the index to be customized and targeted within the portfolio structure. In layman's terms, it's now possible to compare not just apples to apples, but the same varieties of apples against each other. So very granular. This is true for both passively and actively managed portfolios. Passively managed portfolios, those whose goal is to replicate the performance of indexes which they're based, rely on the GICS-derived indexes to be very accurate and the representations of the global marketplace. So let's just go from there, and we'll jump over to, here's the MSIC website, and this actually we'll show you all the different categories again. So again, energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, communication services, utilities, and real estate. This website's pretty cool. So I'm actually going to zoom out here. So energy, you go into energy, industry group down here. It has energy equipment and services, as well as oil, gas, and consumable fuels. Materials, it breaks it down: chemicals, construction materials, containers and packaging, metals and mining, paper and forest products. You can see the granularity here, guys. Industrials, capital goods, breaks it down into all these different categories. I'm not going to read them all, but you can see, aerospace and defense to machinery. There's also under industry, there's commercial and professional services, which breaks down into commercial services and supplies and professional services. And then transportation, of course, you've got your airlines, you've got your marine, you got your road and rail. And every one of these breaks down, so consumer discretionary has automobiles, that breaks into components and automobiles and so on. Consumer durables breaks into, leisure products, textiles, and household durables. Consumer services breaks down to hotels, restaurants, and leisure, and diversified consumer services. Going to consumer staples, that breaks it down again. So you got food and staples, you've got beverage, food and tobacco, household products, and personal products. So next is healthcare. There's 11 sectors. So we're going through each one of these. Healthcare has healthcare equipment services. That breaks down into 3, including tech and equipment supplies. You got the pharmaceuticals, which includes biotech and pharmaceuticals. People get that confused a lot because they'll call, a company that's not necessarily a biotech company. It's a pharmaceutical company, and they use that term universally. But there is a granular difference. There's also the life sciences, tools, and services in that sector, in the industry group. Sorry. Financials is banks, which has banks as well as mortgage finance. Diversified financials has everything from consumer finance to mortgage real estate investment trusts. So there's your REITs, which is interesting because there's also a real estate category. And if you go into the real estate category, it's going to show you equity real estate investment trust REITs again. So it's kind of interesting. There is some overlap here, guys. When you think of, say communication services and technology, there's a lot of overlap within the cell phone industry, in my opinion. IT breaks down software, for IT services and software. There's a technology that breaks down semiconductors and so on. Communication services, so that's telco. It used to be called telco, but now it includes media and entertainment. So the media and entertainment, you've got just everything within there and this is where it can overlap because Disney is discretionary, but also now falls under media and entertainment. So some companies are so big that they cross different categories. Utilities is pretty straightforward, but there's, electric, gas, there's there's water, and there's independent power. And then real estate, we already did. There's the real estate investment trust as well as the real estate management and development. So you can see there's a lot of different pieces that go into these sectors. Kind of moving along. So here's another shot here from another page from Fidelity, and it talks about current market weightings and recommendations. Now, I won't spend a lot of time on this, but you can see as of right now, this is as of today here, information technology is 24. I'm not going to read them all, but 24%, healthcare, financials, and so on. You can see on your screen. So IT is 24%, healthcare is about 14%, financials 12.5%, communication services 10.5%, consumer discretionary is just under 10%, industrials 9%, consumer staples 7%, energy 4%, utilities 3.4%, real estate just under 3%, materials 2.5%. Now, you don't obviously have to follow this to a T. This is just some recommendations to keep it by. I also like to go. You can go to this website here. I'll put it in the comments below, but you can go to this website that breaks down different sector weightings. And here's the S&P 500 index. And I like this because it shows a historic chart from 2015. So you can see back in 2015 that the consumer discretionary was 12.89%, and today it's only 9.75%. And going back up a line, communications, if you look down at the very bottom, telecommunications, it says discontinued right here. So it used to be telecommunications, and then they made a new category called communications back starting in 2018. Consumer staples, you can see, back in 2015 it was 10%. Now it's 7.2. and so on. Energy has trended down from 6.5% 5 years ago to, a little over 4% now. Financials used to be 16.5. Now it's only 12.9. Healthcare is pretty close to the same, but you can see how it kind of has moved around a little bit over the years. Industrials is about % less than it was 5 years ago. IT has grown from 20.69%, slowly grown every year, to 23.2%. Obviously, you've got huge mega caps in there like Microsoft and Apple that have inflated that number. Materials is pretty much going to be stable right under that, around that 2.5% to 2.75%, max out about 2.99%. Utilities is the same, around that 3% range, and then real estate as well. And so I usually category, when I'm doing this, I like to put energy, utilities, and real estate together. Materials, I personally don't invest in those, but a lot of people like to have gold or gold miners, or you can buy silver. We've got a little bit of silver. Actually, my wife and I do. But not a whole lot of materials. And it's not just, when you think of materials, going back to these sectors here. So, of course, this doesn't break down. So here's materials. If you break down materials, it has chemicals, it has metals and mining, it has paper. So we've got, chemical stocks. We've got a chemical mutual fund with Fidelity. I own some Dow. I've got international paper. I've got all these. I just don't have a lot of metals and mining. So a lot of people, when they see that, they're automatically going to think materials. A lot of time they think metals and mining, but it's all of those. And then this last slide here, this is pretty cool. So this, you can go to this site again, and I can put the link down in the comments. This is the Dow Jones US Completion Total Stock Market Index, and you can break these down. In a minute, I'll go to another one. But this here is the Dow Jones, and you can see as of right now, as of December 31st, 2019, financials in the Dow, this is the Dow, were 27%, and technology only 16%. Okay, and you can see on your screen on the pie chart what each one is. Financials dominates it, and then industrials, and then tech. So finance and industrials is really going to dominate. You're going to see your Boeings in there, and from the technology side, IBM and so on. But the big banks are going to be in the financials, and it's 27.3%. If you look at the SP Completion Index, now let's look at that index, because this is going to be different. So when you break that down, so here's the S&P. This is the S&P Completion Index, right? So let's look at that sector breakdown. Now you can see the information technology on this one is 17.8%, financials 17.6%, industrials 13.7%, healthcare 13.5%, and so on. Energy is the lowest component with 2.5%. So what does all this mean? Well, you can pick whatever index you want to follow. You can also buy an ETF if you want to do it that way. But it's just a good rule of thumb. So you definitely don't have to follow this, and I personally don't. I'm more NASDAQ, and I'm more tech heavy. In fact, my taxable account, I've got about 40% IT. I don't recommend that necessarily. It's just I invest in what I know, and I come from a tech background. But these give you a good rule of thumb, especially, say everybody probably has enough IT and technology stocks in their portfolio. But you might not have any energy or utilities or staples. This gives you a rule of thumb to say, hey, if I've got a $100,000 portfolio, if I want to try to, be diversified, I should probably have a couple percent of energy and a couple percent of utilities. You could decide not to, but it's at least good to understand the general indexes and percentages, so you can have some sort of rule of thumb to base off of. And if you want to make your own strategy and say you want to do 25% tech and 20% financials, and that can change, right? So, a lot of people will chase the sectors, and they'll invest in even ETFs that will chase, performance. So, but at the same time, you got to be careful. You don't want to have 100% of your stocks and just in tech stocks, because tech is doing well. That's going to hurt you really bad when the market turns. If you look at any kind of sell-off, we just had a sell-off yesterday. All the high flyer tech stocks, they're down 5%, some of them 10% during intraday trading. That for some people, that's pretty scary. That's not going to happen, if you're holding on to a lot of bank stocks or, you know, a utility stock, it's not going to have as much movement on a daily basis. So it's good to be diversified. It's good to have a little bit of all these. You can make your own formula of what works best for you. You know, for example, if you were to look at mine, I'm pretty heavy in IT and healthcare. I'm actually a little light in financials, and I'm trying to address that. The thing that's also something I want to point out is when you think of Visa and MasterCard and PayPal and all those are considered tech stocks usually, even though they're financial tech. So they're fintech. I personally put fintech in financials. So my technology will show 40%, but if you're actually to go in and dissect that off of Fidelity, when you go into Fidelity and click analysis, it'll break it down for you. Mine will say 40%, but it has Amazon, Amazon not in tech, and then it has things like Visa and PayPal and MasterCard. It has those in technology when I really consider them financials. So just keep that in mind. Use this as a rule of thumb. Now, as I mentioned in the beginning of the video, I'm going to be doing a series, and I'm really excited about this. So please do subscribe. Click the little red button on the bottom right-hand corner. Make sure you click the little bell to get notifications. In the next few days, I'm going to release the first video in that series. There's going to be 6 total videos that are going to cover all of these sectors, and there's going to be a total of 60 stock picks. So I'm not going to give you any more details than that right now, but please subscribe because you're going to want to see this, and it's going to be a great way for you if you look at your portfolio and say, man, I really need to get some more financial stocks. You know, what should I even, where should I even start? I don't know what banks are good, what's considered financials, maybe some areas I haven't thought of, like in the insurance side of financials. You know, so it's important to be subscribed so you get notifications, because I'm really excited about this series. It's going to be the best series that I've done to this point, and there's going to be some great individual stock picks on there that can really help your portfolio outperform. And these are going to be picks that I recommend to hold for 10 years. So for the entire decade of from 2020 to 2030. So these are going to be buy and hold type stocks that you can buy and hold in your portfolio for the long term. I appreciate you watching this video. Again, please subscribe. I'm excited to announce this series in a couple of days. Thanks for watching. Have a great rest of your day. Take care.